We've already talked a good bit about open-end and closed-end fund. And you might say, hey, maybe there's something in between. The open-end fund had the advantage of being able to grow the actual net asset value just from more investors coming in. The closed-end fund, but there's a disadvantage there, is that you had to keep some cash on hand. If people got scared, a bunch of people might leave the fund and the fund will shrink, forcing it to sell assets, possibly at the worst possible time. On a closed-end fund, the weakness is that it was kind of a fixed net asset value, so the fund manager might not like it. Even if they're doing good, more and more people can't pile on, at least on a typical basis. But the benefit is that these shares right over here, when people do want liquidity, they do want their money back, instead of having to transact with the open-end fund and the open-end fund having to keep all that cash on hand and all of the expenses of the transaction, they could just trade it on a market. And there is indeed something in between. It's called an exchange-traded fund. Exchange-traded fund, often referred to as ETFs. ETFs for short. An exchange-traded fund, like an open-end mutual fund. So let's say there's an exchange-traded fund right over here, and has a bunch of shares. It has some net asset value. In an exchange-traded fund, like a closed-end fund, these shares can be traded on an exchange. Traded on exchange. And for the typical investor just wanting to buy one share or redeem one share, they're not allowed to do it on their own. And so that frees the exchange-traded fund from some of this overhead that the open-end mutual fund has to worry about always keeping this cash on hand, the overhead of having to transact between its shareholders on a daily basis. But the way that an exchange-traded fund kind of compromises and still allows itself to grow or even possibly shrink is it will do new share issuances in bulk. In an open-ended fund, it would be one share at a time. In an exchange-traded fund, they will do it in bulk. So they will do it only with certain parties who can transact in huge volumes. And one of these parties can say, okay, I want another 1,000,000 shares. So they will buy another 1 million. They will create another 1 million shares, sell it to the appropriate party, and then that will increase their net asset value. So what does this do for the exchange-traded fund? Well, they have none of this overhead of these redemptions every day with the smaller investors. They can only do it in bulk. So this means that they have lower expenses, which means that they can pass that on to the shareholders and have lower fees. They are also not actively managed, so they tend to not be actively managed. Not actively managed, which once again drives lower expenses so they can have lower fees. What do I mean by not actively managed? Well, an open-end fund will typically say, hey, we're great stock investors. We can do better than the market. By investing in us, you're going to get a team of researchers. You've seen the commercials on TV where they're analyzing companies and they're getting on planes around the globe and looking very worldly. An ETF says, well, look, we think that we can't do any better than the market. We're not going to actively manage. We're just going to take the assets and buy, let's say, all of the stocks weighted appropriately of the S&P 500. Or maybe it's an exchange-traded fund for some type of a commodity. We're going to take all of these assets and buy some type of a commodity like gold. And that's useful for the shareholder, because it's very hard for an individual to get the diversification of the S&P 500, to buy all of the shares and the appropriate weighting and keep reweighting it. And it's also hard for an individual investor to buy a little bit of gold or even a lot of gold and store the gold and sell the gold and secure the gold. And so the exchange-traded fund can do it in an appropriate way. Now, one question that you might be having is, outside of these large bulk transactions that create or redeem the shares that already exist in the exchange, or that create more shares, the shares are being traded on an exchange. And we talked about closed-end funds. We talked about, because they're traded on an exchange and you can't create or redeem any new shares typically, the shares could trade at a premium or at a discount to their net asset value. Now, what would be the case for an exchange-traded fund? In an exchange-traded fund, they actually typically trade very close to net asset value. So trade very close to net asset value. So why do these exchange-traded funds trade close to net asset value while closed-end funds don't? Well, in a closed-end fund, there's no easy way to arbitrage. Even if it's trading at a significant discount, you can't buy those shares and then somehow try to redeem those shares for the net asset value. In the case of an ETF, some of these large shareholders, these large transactors, these people who the ETF will transact with, could do it. If these trade at a discount, if these trade at a discount, what you would have happening is a large number of the larger I would say dealers could buy a bunch of them at a discount and then redeem them with the actual fund itself, and then they would make a profit. Similarly, if it traded at a premium, the large dealers could buy more shares, so the exchange traded fund could create more shares, and then they could sell it at a premium to net asset value, and they would essentially make pretty close to risk-free money. And so because there's this arbitrage opportunity with exchange-traded funds, they tend to trade very, very, very close to net asset value. And oftentimes, because it's very transparent what they're doing here, that they're either buying the S&P 500, the NASDAQ, or gold, or oil, it's very clear what the net asset value is, or very close to what it is, even during the trading day.